You ever stop to think about how banks actually make money? Do they have a printing press in the back where they're just running off those fresh, crisp $100 bills? Today's video, we're going to be breaking it down. How do banks create money and how do they create profitability? Now, with banks and money, it is completely intertwined. They are kind of one and the same. Doesn't mean that a bank has unlimited access to a constant source of cash on hand, but most of the bank money does not take a physical form, meaning, of course, it's not printed out of the back. It is not physical bills that they have on hand, but it is a multi-revenue sources that they remain intact and make money, giving a lot of it back to the shareholders. Now, most often this money does come from consumer deposits. So what this does is when you bring money into a financial institution, you deposit your money, the institution takes your money, makes it in the form of a loan. So they take the money that you put in, they give it out to other individuals, which of course can create more money. This is a single bank money creation. This is really the easiest way. So accepting deposits, creating loans is the most important way to do this. Now, there's a couple things to remember. When it comes to financial institutions, they do have to keep a certain percentage of cash. When you see financial institutions that are failing, it is usually because they don't have enough cash on hand to meet the demands. Now, according to the Federal Reserve, they have to carry 10% is kind of the requirement, the bank reserves that they have to have on hand. So when you think of an institution in all of their locations, 10% of that does have to be maintained, 10% of that on hand. So let's say a bank has $5 million in deposits. That is coming in from customers. So bank takes in $5 million. There's a couple different ways that they can turn this $5 million into a lot of money to turn profit, which is one of the reasons why banks are one of the most profitable companies that we see within the world. Now, of course, we take in our $5 million. We're required to keep 10% of that on reserves, meaning our $500,000 is on reserves. We're holding on to that. That gives us $4.5 million that we can lend out. This, of course, is going to be kind of what we're using for savers, for borrowers. This is where we are holding your funds till we decide what we're going to do with this. So let's say we take that 4.5 million or just a portion, let's say $500,000, we give it out to a loan. So there's a company that is looking for a loan or an individual that is looking to get a mortgage. We give them $500,000 to go ahead and get whatever they need to. Now, of course, we have the remaining balance that is still on our side, meaning that we still have that $4 million. Now, when we give them a check for that loan, they take it to another institution, they deposit that check, or they essentially buy something with that $500,000 that we give them. And that is going to go into, again, let's say the deposit goes into another institution. That institution is only required to keep 10% of that deposit. So they take their $50,000 that they have to have on deposit, and so on and so forth. It goes on and on and on. This is actually how banks create money. I know it's kind of crazy to think about. In addition to really the money supply fluctuating, as the small business pays back its loan that we borrowed them, that $500,000, it can also go in and the new bank that they deposited the money into can go ahead and make loans. Now, there is a money multiplier. This is where it gets a little bit confusing for a majority of individuals because this will increase and it will go up for the bank's money supply. Now, there is, of course, a predetermined rate. So we're going to run through a couple scenarios and help you understand exactly what we mean. So banks creating money. So let's say you open up accounts. So we're going into a financial institution. We're depositing a fresh $100 bill in there to open up that account. Now, of course, the institution only has to keep that 10% on reserve, meaning we hold $10 aside. $90 is there to evaluate or essentially to lend to earn interest. So if you bring your money into a Bank of America and they're paying a 0.03 on your money, you bring me $100, I'm going to go ahead and keep $10 of it. That is going to have to stay in that reserve. $90 is going to be lent out. And looking at interest rates today, I am lending that out at 8, 9, 10, 12, 15% interest on the money that you're giving me. So I am paying you almost absolutely nothing as a financial institution, but in turn, the financial institution is making an incredible profit. I mean, when you're talking again, even looking at credit cards where they're 20, 22, 24, 30% interest, the money that you're giving me, we are lending back out to individuals. Now, this formula is very proportionate on the reserves that the banks have. So again, when you think of this on a big scale, when you're talking about one person bringing in $100, what about when you talk about 1 million, 5 million, 10 million, 100 million people bringing money into a financial institution? that financial institution keeps that 10%, and boom, the rest of the money goes right out the door in the form of loans. That is really the way and the methodology behind how banks do create money, but also how they earn money. So what does affect this in a high interest rate environment? Again, when you start looking at high interest rate accounts or high yield savings accounts, even looking at CDs, this is where the competition comes in between financial institutions, because all of them have to have deposits to have the ability to actually borrow out money. So if I'm taking in $5 million in deposits, I have to keep that 500,000 or that 10% on hold, meaning I can take 4.5 million to go ahead and move that or essentially lend that out so I can get the profit from that based on the interest rate and based on the ability to pay. Now, there are a couple caveats to this. When you look at some of the online banks or some of the virtual banks that don't have physical locations, they can offer a lot higher interest rates on CDs and savings accounts because they don't have the overhead, they don't have the staff, they don't have the physical locations, they don't have the taxes, the payroll costs. That is why when you look at M1 Finance, like what I use, we have a link right down below, but it is very, very high, paying 5% on a savings account because they don't quite have the overhead of those physical locations. Now, of course, the access to funds is where a lot of banks do get in trouble. They have to be very careful to balance exactly what the reserves are, because if the reserves are a little bit short, they're going to have to sell bonds. They're going to have to borrow money themselves to make sure that those reserves are back. When there is a bank run, a lot of people come to an institution to pull out an absorbent amount of money, meaning that the financial institution doesn't have enough cash to actually give out. This, of course, can leave them short in a very dire situation. Now, of course, there are a lot of economic concerns with this. And again, this is kind of the concerns that we have with financial institutions is when you're lending an individual money, you can base it on everything that you want to. You can look at their payment history, you can look at their credit scores, but inevitably it is faith-based. You are reliant on the individual to actually repay the loan and the money that you're borrowing them. If they don't have the ability to repay that loan, then you can get into, of course, collections. You can also get into a lot of charge-offs. You can see delinquency rates go up, which is unfortunately what we're seeing right now in the United States. As things get more expensive, as the consumer price index increases, as inflation hopefully has leveled off at this point, as people quit paying, and this can happen in a very big environment. When we think of 2007, 2008, that's exactly what happened. Just like dominoes, a couple people quit paying the mortgages, then a lot more, then it just catastrophically, a lot of people stopped paying mortgages, making all of the dominoes fall. And that is kind of the simplified version of what happened. Now, when you deposit in the bank, of course, we do have insurance. You have the FDIC, which is for banks. You have the NCUA, which is for credit unions, meaning the money in there is kind of insured. It is insured depending on the limit that they have. So if a bank does go belly up, you will get your money back, but it might be a little bit of time before you get that. But overall, the generation and the moving of money from institution to institution can be kind of crazy to think about how they are actually borrowing money, keeping a portion of the reserves to go ahead and make those deposits. Now, of course, if a financial institution is offering high yield CDs, we see 5.5%, 6% at some very remote locations. But when you're looking and starting to get into the higher interest rates, there's two things you really have to look at. One, what is the financial stability of the bank? Now, we see a lot of banks and credit unions when they're having financial trouble or they can't bring in enough deposits to cover the loans that they lent out. This can be very detrimental, meaning that they don't have enough money to cover that 10% reserve that they're required to have. And the second one with this is, of course, looking at the interest rates. So when you think again, when you're thinking COVID time, 2020, 2021, where mortgage rates were 2.5%, 3% on mortgages, they locked those in for 30 years. If you're thinking right now where mortgage rates are around 7%, those 30-year mortgages are locked in at an ultra low rate, meaning that it is going to cost the financial institution a lot of money to keep those on the books because they could be making a loan today at 7% versus having the individual that's only paying 2.5%, which again, if the financial institution isn't balancing this properly, you can see again a lot of failing situations with institutions. Now, we've seen quite a few over the past 2 years. We've seen a lot of institutions that are failing because of the rising interest rate environment. I think leveling out, it seems like it's getting better, and a lot more of the stability is coming in when it comes to exactly where the prices are. I know a lot of people are holding off on mortgages, are holding off on car purchases because the rate is so much higher, which again can influence not only your debt to income ratios, but it can also influence the amount you're going to be paying for that monthly payment. When you start looking at the average car price of around 50K, you couple that with a 7% interest rate, all of a sudden your payments up to, closing in on $1,000 a month, which for a majority of people is way too high, especially when they have high interest credit cards, when they have a lot of other combining factors. Student loan debt is another big one that I think is kind of crazy, but I wanted to cover exactly how the banks create money because it's kind of interesting to see, working in a financial institution, exactly how it is created and how it can be kind of infinitely created as long as that 10% reserve is met. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.